Derivative. This is a financial instrument which triggers different emotions amongst different people. Whether you talk to traders, financial accountant, financial controllers, finance directors, CEOs, CFO, everybody has a different emotion, sentiment, different opinions, and experience with derivatives. For various reasons, still, it is indispensable for the financial world and economy at large. Many companies have been and will continue to make massive profit and also will protect their business using derivatives. So, ladies and gentlemen, today I'm going to talk about one of the very, very important derivative, which is options. How this can be used to protect the profit or make the profit. What are some trading strategy around this? Its background, its strengths and weaknesses, and overall, as an investor, how one can use options in their trading strategy. How anyone can use options as part of their trading strategy, their trading practices, and I want to kind of address some of the concerns and the fears around options as well. So let's embark on the journey. I will explain this with some practical examples and calculations as well. And there will be a step-by-step discussion with the help of PPT so that you can see what is being discussed. So here I'm going to share a PowerPoint slide. So as promised, this session is about options, and it's a part of the derivative strategy series that FinSep Institute is providing for everyone at large, and you can benefit from this. You can be a student, professional, or you can be a trader. It will be equally useful for different professional as well as the investors. So moving on to the basics of derivative and options basically. First, let's understand why the derivatives are so important. Derivative is something that derives its value from its underlying. So though option is one of the derivative, but option also does the same thing. Option also derives its value from an underlying. Say for example, if one day I come to one of you and ask that, okay, can I get Mr. John or Mr. Pawan, can I get 10 gram of gold from you in just say 45,000 rupees? And when? 90 days from today. As we have seen, the tendency and the demand of gold, it seems that from 43,000, 42,000, it can continue to rise. And I might think that gold could be 47,000 per 10 gram, right? And if I think it's going to be, say, 47K per 10 gram, but if I can get, get your commitment to sell me only at 45K per 10 gram in 90 days from today, this could be a great deal, isn't it? Because we all agree that gold seems to be on a different onslaught. It is on a bull run. It's not going to see any stopover. So if in all likelihood it is going to continue the graph like this, in 90 days I'm likely to make 2,000 rupees per 10 gram, right? And it will be a great deal for me. So something similar happens in options as well. One can speculate, one can do their own research and find out where things are likely to move. And it is not only gold, it could be with any commodity, it can be with sugar, it can be with oil, petroleum products, it can be with various different commodities, silk, various type of food and grains, commodity, meat, anything can be traded in the option market, and one can buy the right to buy some of the commodities at a cheaper price. So this is just a very high level background to explain you why options can be strategically important. Moving ahead, option also have two different types, which is called call and put options. We'll talk about that because when one person is trying to buy, another one has to sell as well. So both sides of tradings are required, which is called call and put options. We'll talk about that as well. But here we need to also understand why somebody needs to buy and sell options. Apart from thinking that, okay, gold is getting expensive, what else can happen? As the trader, why do you need an option? It could be for various reasons. One can be that you have already invested in airlines company, and if the oil price continues to go up, you might make a loss, right? It often happens. So you might think that, okay, if I'm going to make a loss on my airlines stock, then I might just compensate from the gain on oil stock. But the problem is, what happens generally, if oil stock is going up, then airlines stock will crash. And you don't want to buy and hold oil stock as well as the airlines, both. You just want to have the kind of exposure, Exposure means that you want to be able to gain if oil stocks goes up or oils become more expensive. Because when the airlines stock goes down, you want to make sure there is something which compensates you so that your plus and minus balance out each other. You are not losing money, you are still netting to the same value, right? So just to make this clearer, let's take a numerical example. Imagine that your airlines stock is crashing because of oil. Okay, so here is your airline stock, which is going down. Okay, and you own the stock, so stock bear owned. Now so, Nitish told you that why don't you just get some call option in this case. So the call option will be a right for you to buy oil stock. So you got, say, 10 call option, which means you can buy oil stock at lower price, which is fixed today. Okay, so what could be the price fixed today? If you think that, okay, the airlines industry might go down, but you can just fix, or maybe you can lock the price today itself. So you want to buy oil at $100 per gallon in 90 days. Even if it becomes say 125 per gallon, you will be still able to buy it only for 100 within 90 days or in 90 days, right? Now, what happens generally? You just have to pay for say 10 such contract, and you have to pay some premium and commission. So it will be like say 10 contract, and commission for each contract could be say $2, and it will be $20 commission. You paid it, and you are going to get exposure or benefit or gain if the oil prices start to move. So as you expected quite rightly, oil stock started to move up because you remember the airlines stock was going down. So oil stock started to go up, or maybe it is because the oil stock was increasing, the airlines stock was going down. So what happens is that oil stock has started to move on. You had got the contract at this price 100. In 45 days it became 115, and in 90 days you got lucky, it became say 125. But what price you are going to buy this? What is your right to buy? You can still buy it at $100, right? So you are making 125 minus $125 per contract, and you already had 10 contracts. So 10 times 25, you are making $250 from this option contract. It is great because you know that here airlines industry is not doing so well because of the oil price, and you had made some loss of around 200 or maybe $300. Okay, but this is being offset partly maybe by $250 gain on the options for oil. Great news. So you are in a way being protected from the crash in aviation sector. Now back to our favorite slide. What if you were able to predict this coupling or this movement between the commodity and the stock, or maybe between the two stocks, or maybe you were able to predict any other movement? It is a great thing, and it happens. If you start to watch the market, understand what is happening, you are good in fundamental analysis, or you hire somebody or you follow somebody who is good in fundamental analysis, you'll kind of start to get an understanding that what is happening in the market, how things work. So in this case, an option can be used to protect your portfolio. Also, you can use option without any stock. Here you had airlines stock to protect, but you can also, without owning any airlines stock, you can just bet on the fact that there is some problem going on in Gulf countries, or there are some international tension which can result into oil price going up, or maybe the oil producing companies are planning to reduce the production of oil. So generally what happens, if the supply of oil is reduced, there will be increase in the price, of course, right? If your research or your advisors told you that the price likely to increase in oil market, you can buy options to make money on that, because as the prices start to go up in 90 days or 6 months time, you can buy that at a cheaper price if you have an option to buy, right? So these are two examples. Thirdly, imagine that you have international operations, international businesses. You are a multinational company sitting in US, and you have invoices coming from to be paid by Australian vendors. Okay. So if somebody is actually Australian clients, so if somebody is paying you 100 Australian dollar in 90 days, and Australian dollar start to get strong, what will happen? Will you get more USD or less? If Australian dollar becomes weak, basically, then quite likely you are going to get lesser US dollar. But if Australian dollar is getting stronger, then you are going to get more US dollar, right? So in the business, things can change. The foreign currency can change. The commodity market or stock market can also change anytime. And generally, if your payment is pending for 1 month to 3 months, you are also nervous about the foreign exchange market. Then you can go into the foreign exchange options or contract. You can buy FX options to protect your exposure to fluctuating or volatile currency market. So this way, options can be used in so many different ways, both to protect your profit, to protect the business, but also to make profit. There is a very interesting movie, and in fact a book as well, called Long Short, and it has discussed quite in detail how the options and the shorting, leveraging can make or break the businesses. And if the derivatives and options are not used carefully, this can be dangerous for the entire firm. Of course, with options, we still have certain degree of security and safety. Hence, when you start to use this in the trading, you can rely on some downside and upside both risk, and you need to calculate first what is your upside potential and downside risk. For whether you buy a call option or whether you buy or sell a put options, you need to be aware of the risk associated with buying or selling an option, and what are the rewards, this is what we are going to learn in forthcoming slides. So before we move on, we can also cover the fact that options are traded on both type of markets or exchanges. There are two types of exchange. One is regulated and structured. So that is formal exchange. And then the second one is kind of a unregulated market, which is OTC, over the counter. Okay. So such markets are also in existence where people can buy options in a structured manner on exchange, plus in an OTC manner in the OTC markets. And derivatives are contingent claim because their payoff depend on the value of other securities. So that's a typical definition of option and derivatives. The next one is option, which is the call. So the call is the buy side of the option. So as we discussed earlier, option have two types. So call option and put options. So when you go long into a position, so generally the long is the language when you want to buy something. Okay, so that is a long. When you want to sell something, it is called short in the language of trading. So for short side of the option, if you want to short something, if you want to sell something, because so far we have discussed that you wanted to buy the gold, right? There could be also a situation that you think that, okay, the gold has already gone too high, 43,000 per 10 gram, and you want to sell that in the future to someone. Okay. So in that case, you want to sell it at a higher price, because if it is a 43,000 and you think it could just crash to say 40,000 in future, you want to buy to sell to someone at minimum 43,000 or maybe 42,500 at least. So what will you go for? You will go for a put option, not a call, because in the call option you want to buy. But if you want to sell to someone, you need to buy. So you need to pay for a put option. Put option entitles you to sell something to another party, right? So in the put, basically you will get a right to sell the gold to somebody at 43,000 even in 90 days time. Quite likely, as you think, the market will crash. The gold will be sold at 40,000. So taking that as the gold example again, so in 90 days, you think gold will sell at 40K from now at 43. For many traders, it will be a loss, but you, knowing the market, you want to buy a put option. So put option says that you can still sell this at 43K per 10 gram in 90 days. So when everyone, so market crashed for gold, now it is at 40K. You can sell 10 contract of gold at 43 when the market is only 40K. Okay, that means you are making a profit of 3K per contract, which is 30K rupees INR. Okay, so just like a call, you can have a put option when you think market will crash. Okay, so this is what we are talking about here. It generally call or put both options. Actually, call and put both options have a strike price which can be exercised on or before the expiration. Of course, before the option contract ends, you can exercise the contract or the option at the rate of exercise price or strike price. So what is the exercise price here? This one, 43, because you have still been able to sell the gold to someone at 43, right? So generally 43, the price that you are still entitled to buy or sell at, that is called strike price. The current price, what we are talking about right now, if we check online, it could be 43,000, some couple of hundred rupees. That is called spot price. Okay. So exercise price is the one which is used for call or put in future. Okay. So in case of call, exercise the option to buy the underlying asset if market value is bigger than strike. Now let's go into some more details. Or maybe we can just catch up with puts as well. So we have already talked about put. Put means when you want to sell something at higher price. And what is call? When you want to buy something at a lower price. So this is put. And call, as we can see in the previous page, we want to buy. Put gives the holder, so somebody who owns the call option, the owner of the call option, the holder of the right, can buy an asset at a lower price in future. On the contrary, on the opposite side, if you own a put option, you have the right to sell the asset at the exercise or strike price. Normally, you think that it will be a higher price that you're going to use while selling because the market has gone down. Sorry, just bad drawing. So market has gone down, but you can still sell at this level. Okay, so this will be your profit. So put give you the right to sell something at a higher price, and call give you to buy something, means a commodity or a stock or bond even or currency at a lower price. It is advantageous, isn't it? But just take a step back and think why somebody will allow you to buy or sell at a higher or lower price. As simple as that. Because if I am forced to buy something at a higher price than the market, or if I am forced to sell something, right, at a lower price than the market, it is going to cause me loss. So why would I agree to do that? This is where the entire contract and agreement of option comes in picture. So when I have an agreement with, say, Mr. Pawan or Mr. John, right? So I have a contract with Mr. John, and he gave me, so let's have a call option just to simplify things, a call option. Okay. John is giving me right to buy gold at the rate of 43K in 90 days. What does that mean? That means that I'm the holder of call. So call normally has two party, right? As well, buyer and seller. I'm the buyer of call. Me, Nidhesh, I'm the buyer. Okay. But for every buyer, there has to be a seller. Who is seller? John. Maybe one of you, or anybody else your trader can find out or exchange will allow, right? So John is the seller. So what happens? Nidhesh can buy gold from John at lower price. Why John will allow this? Because Nidhesh at the start of the contract will give John a premium, just like insurance premium, right? So John will be paid maybe 10 USD per contract at the start for letting Nidhesh buy gold at the lower price in future when the price goes up. John will allow me to buy from him at a lower price, which is 43K only. Okay, so when the market is 45K, I can buy from John at 43. But to allow that to happen, John first will get a premium or kind of insurance premium, which is $10 per contract at the start. And it is very advantageous contract for me, for Nidhish as well, because Nidhish has the right to buy at 43K. What is 43 here? Because Nidhish can buy at 43K, this is a strike price, or also called exercise price, right? So 43K is strike or exercise price. Now John has to bear the loss if Nidhish use the exercise, use this option, and the market is at 45K. But it's fair because John has been paid a premium and insurance at the start, right? This can also happen that market actually does not go up to 45. Market actually crashes and it becomes 42K, right? Now question is, would Nidhish still go and buy from John at 43K? No, because when Nidhish wants to buy more gold, he will buy from market, which is already at 42K. And he will just allow the option contract to expire. Nidhish will not use the option contract. He will allow that to be expired. Now, the question could be that, oh no, this cannot happen because there is a legal agreement, there is a contract between Nidhish and John. This is true, there is a legal contract, but in options, the legal contract says that Nidhish can buy at 43K from John at this is strike price, but it gives Nidhish an option, right? What it gives Nidhish? It gives Nidhish an option. This option. That means there is no force to Nidhish. Nidhish is not obliged to buy from John. Nidhish has right to buy, but no obligation. Okay. So this is why it is also called option. It's a good way to remember. Option give us the option when we have bought it. Okay. Remember, when we have bought it. So when Nidhish has got into the contract, he can use this option or he can just ignore it and let it expire. Now, let's look at the other side of this story. John. So if Nidhish let the contract expire because the gold was selling at 42K in 90 days and he just bought from the market rather than going to John, what happens to John? John just does not do anything because he had got the $10 at the start, this premium, and this premium becomes his profit. And he will just pocket it and he doesn't have to do anything. Only if Nidhish comes and wanted to exercise the call, then he is obliged to sell gold as per the contract to Nidhish. So another aspect to pay attention to, in case of such contract, when let's have another slide just to explain this. In such contract, in this call option, there is a buyer and a seller. Similarly, there is a put option. There is a buyer and a seller. Very symmetric situation. So, buyer has all the rights, but no obligation. Okay. Similarly, in the put option as well, buyer has all the rights, but no obligation. What happens to seller? seller has obligation to comply to the contract if Nitish comes back asking for gold, but has no rights. Maybe but just right to premium, maybe no right or right to premium, that's it. Here similar situation, obligation, because put option, the seller who has sold the agreement has only the obligation and right only for premium at the start. Okay, so we need to just see and visualize how it works. There is a call option, there is a buy option, sorry, there is a call option, there is a put options, then there are two parties for each type of contracts, buyer and seller, and their profiles are different. Buyer has only rights, no obligation, and the seller has only obligation and no rights, and the situation is same for call as well as put options, right? And the fact that there is kind of, it seems that okay, the option contract is unfair between buyer and seller. It is not really, because buyer has all the rights and seller has all the obligation. But just to pay attention here, that seller has given this right to buyer. Seller has at the start of the contract given all this right to buyer and have not asked for any obligation. And why it has been done? Because in the business there is no free lunch. Nobody gives anybody just the right. Nobody gives somebody else all their rights. There's no free lunch in the business, and especially in the financial industry as well. So why the seller has been generous? Is he a saint? Is he a seer? Not really. This seller also thought that market is going to be in their favor. So they have sold this contract, which seems quite unfair basically, but in fact seller has agreed to this contract. And why? There has been a quid pro quo. You know the word quid pro quo. This means there is a mutual benefit, okay? Or literally speaking, there is a exchange of benefit, or benefit to both parties. So seller has got a premium at the start of the contract and said to buyer that okay, I give you all the rights, but you don't have any obligation. If you want to buy something at a better price, come to me, but to get that right and no obligation, you need to pay me a premium at the start. And the same story goes on for put side as well. The buyer has the right to sell. The buyer, this guy, has the right to sell the gold at a higher price to seller of the put option, right? But buyer has no obligation. Why? Just like a call side, buyer has given this guy, the seller, a premium at the start, and for that premium buyer is saying that okay, I want to sell something at a higher price and you need to buy it if the market is against me. So seller will oblige, seller will agree, will say okay fine, I will buy at a higher price because you have paid me a premium at the start. If the market is such that put option holder, which is a buyer, always the option holder is who? The buyer. Buyer is the option holder. So buyer who is the writer? The seller. Seller is the option writer. Okay. And why they write? Because they get a premium. So buyer has all the rights, seller has all the obligation, seller has got the premium, buyer will get some benefit in the future if the market turns to be in their favor. So this is the relation between buyer, seller, put and call options. This is how it works. So in case of put and call both, the option can be expired worthless as well if the market condition is not useful. And the seller, the writer of the options, will keep the premium, and that is their profit. Now we need to take a step back and think again that what happens if suppose you one day think that okay, you want to become a seller of options, right? Because you need to use this in a very live and practical situation. You need to use this concept in a trading situation. So how would you use this? If you want to become a writer of a, say, call option, what will happen? What kind of risk is that you're going to get into, and what kind of reward is possible? So generally it is said, if you are a writer of the if you're a writer of a call option, you have a limited profit. Why limited profit? Because you are only entitled for a premium. You're not going to get massive benefit in the market. That is fixed. $10 I pay at the start of the contract, or $15 per contract, that's all. You don't have massive luck waiting ahead. So a very limited premium, a very limited profit potential, but your risk is unlimited. The risk potential is infinite. Infinite means infinite. It has just it has no limitations. Because imagine this situation now. You are a seller, you want to become a seller of the call option, and I'm a buyer. I say that, okay, Mr. John, going by this same person, or let's change the person, don't want to make too much loss to Mr. John. So Mr. Pawan, okay, you wanted to sell the gold options to me, and you got 10 or maybe say 100 rupees per contract, okay, 100 rupees for per 10 gram of contract. So what happens is that I pay you 100 rupees, so that is your gain outrightly. But if the gold becomes say 100,000 or 100,000 rupees per 10 gram, that is a massive loss to you, because I'm going to buy from you at 45,000. No matter what is the market, I can buy from you at only 45,000 rupees. Okay, so 45k from you, Pawan. Okay, market is at strike, so spot rate in the market or future rate 100k. What is my gain? My gain is 100k minus 45k, 55k per contract. So my gain is Pawan's loss. So Pawan is going to lose 55k per contract, which he wrote to me, which he sold to me the contract actually for how much? 100 rupees. So he gave me a contract to buy gold at 45k only for 100 rupees of premium, and I had bought 10 such contracts. So Pawan lost 10 times of 55k, because one contract is giving him a loss of 55k, right? So he sold 10 contracts, so there is a loss of 10 times 55k, which is 5.5 lakhs or 550k. Okay, massive loss. Now let's extrapolate the situation further, right? Adding another page here. What could have happened further? I had a right to buy at 45k, right? But what if in a hypothetical situation, the contract, the market for gold could have gone to 200k? What will be the loss to Pawan? 200 minus 45 per contract, he would lose 155K. And similarly, now I can buy at 45K, and maybe if the gold price suddenly shoots up for some strange reasons, 500K. What could be the loss to Pawan? This could be how much? 455. Okay. And it can go on. The example can go on. So this loss can be infinite. So for 100 rupees of premium, which is a limited gain, one can lose infinite amount. This means literally the seller of a call option has limited gain but unlimited loss potential. Okay, matlab you can make infinite amount of loss, you can make unlimited loss. And when I'm saying unlimited loss, it is not like in all cases, it is just like possibility, it is potential loss. Okay, but imagine having a loss potential unlimited, infinite, can be disastrous. So this is what happens to seller of a call option. So while for the buyer, it is a very useful, a buyer can just spend 100 rupees and can get the right to buy gold at the rate of 45K, even if market goes to 100K, right? So great thing for buyer of call option, but for the seller, it can be disastrous. Unlimited liability, unlimited loss potential. But premium or the gain is very limited, only 100 rupees, or it could be 1,000 rupees, it could be $1,000, whatever be the number, but it is a very limited premium, but unlimited loss potential. Okay. Now reverse this situation for a put side. So what happens to a put side? Put has, of course, from the seller perspective, first, seller has a limited gain potential because there may not be gain, but the limited gain is what? The premium maximum. It can go maximum to premium, but the loss potential is this limited or unlimited? That is the question. The loss potential to the put side is limited. It is not infinite. The reason is, if somebody can sell a gold to Pawan as per the put side, so if Pawan has been the seller of the gold put, then what can happen? Pawan has given someone the right to sell gold at say 45K. What can happen in the market which can make him uncomfortable? The gold might crash, the price can crash, it can go to say 30K or it can go to 10K, or it can go to 0, right? 0. So what can happen in future? If gold crashes to say 30K, at the 30K, basically, pawn make a loss of 45 minus 30, 15K. So while the market is selling the gold at 30, basically pawn has to buy from somebody else, because pawn has given somebody else the right to sell to him, right? So pawn has to buy this. So pawn has to buy the gold from somebody else at the 45K, whereas the market is at 30. So pawn is making a loss of 15K per contract. It could be also that gold is trading at 10K. So loss of pawn is 45 minus 10, 35K. And similarly, if it is 0, it can't go below 0, right? Nothing can be sold below 0. If it has 0, then loss of all 45K. Okay. So you can see the loss potential in the put side for the seller, somebody who has sold the right, is limited. It is only 45K maximum. So that means the maximum loss is limited in put for put seller, but unlimited for call seller. Okay. So now we'll jump to the PPT and explore more. Some numerical example, quite likely we'll be good with them, but good to revise the concept. A January 2010 call on IBM with an exercise price of 130 was selling on December 2, 2009 for 218. Okay, so call on IBM with an exercise price of 130. Option expires on the third Friday of the month, which is January 15. IBM remains below 130. The call will expire worthless. Question is that why? Why it will expire worthless? What we have learned earlier. Because IBM remains below 130. Exercise price or strike price. It is also called strike price, right? We have learned this. Strike price is 130, but IBM is still below 130. So if you have a right to buy, right, you have call option. See? You have a call option. So you have right to buy. Would you buy at expensive rate or at a lower rate? You want to buy at a lower rate, right? So you buy IBM below 130 and ignore the options. So it will expire worthless. Okay. Next example, profit and loss on a call. Now, suppose IBM sell for 132. Interesting. Strike price was how much? 130. Now it is selling at 132. So what is the value of option? $2. As per this, profit, final value minus original investment is how much? Negative 18. But why? What is making it negative? Because we just found out $2 of profit per contract, right? So why suddenly things have changed? This is because we are forgetting one thing, the premium that was paid. The stock has moved from 130 to 132. I agree to that. Stock has gone up and we are entitled to buy at 130. Okay, so we buy at 130, hence we make $2. But haven't we paid something called premium? The right to buy this call, the premium, the insurance premium actually. So that needs to be deducted. So that's what is called the original investment. Another way to say it is the premium. So $2 minus 2.18. Why I'm making this? Okay. This is a net loss of 18 cent. See, minus sign, this little minus sign. So we are still overall net loss, but the fact remains that option made money on the exercise price. The option was exercised. Yes, of course, we did not make overall money because of the premium which was paid was higher than the value from the option, but option was still exercised. Okay. Call will not be strictly profitable unless IBM price exceeds 132.18 strike plus premium. Yeah, indeed, makes sense, because the profit will only be made once the original investment is smaller than the value from options, right? So the strike price plus the premium, that should be the price in the market. Only then a call option will be profitable. So if you have to apply this strategy in your trading, you need to be cautious of how much premium you are paying. Is the call option quite expensive? Are you really confident that the market is going to pick up in the future? If the market is not going to pick up in the future, but call premium is expensive, then very likely you will make a loss by going into the call. But of course, if you also have some worries and concerns that your overall profit can be impacted, at least paying a premium will give you some assurance that your risk is going to be limited. Because once you pay the premium, right, of 2.18, once you pay this premium, at least you are protected from whatever the amount it goes in the future, because you are ultimately going to get the benefit from that. You're not going to buy at say 140 or 150, right? You are at least protected by paying $2.18 per contract. But if you think that the price is not going to shoot up quite high, but if you also think that the premium is quite expensive, then maybe the option is not, call option is not the best choice. Okay. So these are some of the practical implications to use call options. Moving on, profit and loss on a put. Considering a January 2010 put on IBM with an exercise price of 130, selling on December, blah, blah, blah. So what happens in a put option? You have a right to sell, assuming that, of course, you have bought the option. You have bought the, let's be specific, you have bought a put option. So right to sell at what price? Exercise price is 130. Wonderful. 130. And selling at December 2, 2009 for 4.79. All right. So this is the premium we need to note. Option holder can sell this for 130 anytime until this. And if IBM goes above 130, the put is worthless. Okay. Yes, because if it goes above 130, what price will you sell? Won't you sell at a higher price? If it goes above 130, then right to sell is having zero value, big zero, because it has no value. I would like to sell at an expensive rate in the market. Selling at 130 is better. Selling at 131, 132, 133 is better than 130. So I will let the put option expire. And remember, I don't have any obligation to use the put option. I have only rights. And why I have the right? Because I have paid this premium 479 at the very start. Okay. Moreover, the put will make profit once stock goes down. So what happens? Suppose IBM at expiration is 123 and exercise price was $130. So interesting, we have delta or the difference of $7. Okay. So $7 difference, investors profit. How much premium was paid? Was paid 479. So this is a net profit. Good news. 221, $2.21. We have made profit because total movement or the delta or maybe the change. Sorry, my handwriting as usual weird. The change is $7. Then we have to subtract the premium. So 7 minus 4.79 is 2.21. This is the profit made. Fantastic. Now another term that comes here, holding period return. What is this? Holding period return. This is something to annualize. So suppose that you made $5 from a contract. Okay, $5 in 90 days. So generally we want to basically estimate that, all right, so how much in a year time, okay, we can make the money. So we generally do 5 times 4 and 20. So we could have made $20 in a year time. So in 360 days. Similarly, we want to sometime estimate that this $2.21 has been made, but what is the total yield? What is the return on investment? So when we calculate return on investment, first what we do, we take the profit 2.21. Then we divide that by original investment, which is 4.79. So that comes to be 46.1%. And in how many days? We see that it has happened within 44 days. So 46.1% return in 44 days. So we can also say that, okay, maybe in a year time it can be even higher return. So annualized return could be even higher. So it could be 46.1 times 360 number of days divided by 44. It would be around 46.1 times 7.5, then some 320% of return around lump sum. So anyway, now we know how to calculate the profit on call and put options, right? Some terminologies to get acquainted with here. So in the money, when we are making money, so in this previous example, when there is a $7 of profit to be made, option is in the money. Earlier, when IBM was above 130 and the option was not making money, it is called out of the money. But when the put option is 130 and it can go either down to make profit or it can go up, no profit. But when it is at the point when any movement can result into profit or loss, or sorry, profit or no profit, that is called at the money. When it is not making any profit or loss, it is at the money. But when it is making a profit, it is in the money. When it is not making any profit, it is out of the money. And when it is at the border, between in the money and out of the money is called at the money, right? So in the money, when exercise of the option would be profitable. That means for a call option, exercise price is less than the market value or market price, because then you will buy the goods at the exercise, sorry, you will buy the goods at the exercise price and you will make money. So it is in the money. For the put, market price is lower than the exercise price. That means you want to sell at the exercise price and make money. So then it is in the money. Out of the money, when, as we discussed, exercise of the option would not be profitable. So for the call, market price is lower than the exercise price, or for the put, market price is higher than the exercise price, right? So it is at a situation when no one can make the money even after exercising the call. So what will happen? The call or put option will be left unexercised. It will not be used because no one wants to buy or exercise the price when the exercise price is higher than the market price. Somebody will try to buy at the market price when it is lower, right? And it will be worthless. When for the put, when we have in the put we have the right to sell. I would like to sell something at the higher price. When the market price is higher than the exercise price, why would I go for exercise price? I would go for market price because I want to sell. Put is about selling, right? Put is about the right to sell. So I would like to sell at the higher price, which is the market price. I will not go for exercise price. So we only use the exercise price when it is profitable. When it does not make profit, we just ignore exercise price. We go by the market price when market price is profitable. But when market price is higher than exercise price and we have a put option like right to sell, I would like to sell at market price at the higher price. So I will let it expire worthless. So when exercise of the option does not make profit, would not make profitable, it is out of the money. At the money when exercise price and asset price are equal. So when say market price is equal to exercise price, then it is at the money. Next one. So there are two other options as well, American and European options. American options are those which can be exercised at any point of time, quite flexible. Any time before the expiration or maturity, it can be exercised, whereas the European ones are not exercised at any point before expiration. It is exercised on or at the expiration date. Now there are some Asian and Bermudan option as well, which has different dates and different pricing, exercise price as well. So there are other different types of options also available in the market for your information, but the two main ones are American and European options. American is a flexible, elastic, flexible options, but the European ones are not. It can only be exercised at the date of option exercise. So it has one single day to exercise only. But American one can be exercised at any point of time during the life of contract. There are different types of options as well that can be written: stock options, index options, because option can have underlines, right? Just like we have been talking about the options for the gold, there could be options on stock. I want to buy Reliance or I want to buy Google stock at a favorable price. So that will be like a stock options. If I want to buy certain future at the price that I want in the coming days, then it is a future option. If I want to buy stock or an index product at the given price in future, then it is an index options. Similarly, I have talked about the foreign currency options. When a company is doing the business globally and is concerned with the currency fluctuation, then it will go into a foreign currency options. Similarly, interest rate options. There are varieties of options. There are options over options. There are exotic options. There are swaptions. There are varieties of different option products as well. We will likely cover those one in a different session. But for now, it is important to know that the varieties of the options and the underlying can change from one option to another options. Payoffs and profit at expiration calls. We have dealt with this in quite detail, but just to cover some formulas. The notation for options are such that stock prices ST. So stock prices are denoted by ST and exercise price is X. So payoff to call holder is what? When the call holder makes a profit, the exercise price is typically lower. So market price or stock price is higher than the exercise price. Only then call holder see the dollar or value or see value in the option. Okay, that's why ST minus X for payoff to call holder. And this happens only if the exercise price is lower than the stock price or the market price. If it is not the case, then zero. Profit to call holder. Simply, whatever the profit is made here, ST minus X minus purchase price, which is what? Premium. We have already seen this here. Yeah. So generally the 7 is the profit from the options. So basically this is the difference between the price and this is the premium paid. Hence the net profit is 2.21. Basically this is what is represented here. Oops. Profit to call holder is payoff minus purchase price. So in the previous example, payoff was 7, purchase price was 4.79 and profit was 2.21. Okay. Back to payoff and profit at expiration call. Payoff to call writer. So remember, whenever there is a call buyer, there has to be a call writer as well, because for every buying there is buyer, there is a seller. So the guy who gets the premium from you to give you the right to buy in future, that guy is call writer. What is his profit? His profit is made when this stock price is higher than the exercise price. Because generally exercise price is going to be lower. If the strike price is lower, then the person would try to buy at the exercise price, because in this contract the person is trying to buy and everyone will prefer to buy something at the lower rate. So if this X, the exercise price, is lower, then the stock, what will happen? So in that case, basically, we will see that payoff to call writer is negative. So essentially what happens in cases of call writer, the price in the market is higher and the exercise price, so let's see the denotation, see this exercise price X is lower. So if the exercise price is lower, the call owner, the guy who paid the premium, will come back to the call writer and will say, hey, I want to buy it from you because your price is more competitive. See, the exercise price is lower, so this call owner will try to buy at this X price. Now, if he or she buy at the X price, where the stock price is higher, then who is going to make loss? If you remember our earlier discussion, there will be a loss to the one who wrote the call, the guy who wrote the call. And in the call option, there is infinite loss to the one who has sold that right to the buyer, right? The loss is only borne by the person who got the premium and sold the other party the rights, right? So it is fixed. The loss will be only to the person who sold the contract and for a premium, right? So the loss made by the call writer is ST minus X. So let me just clean it up. So the loss made by the call writer is ST minus X. And this negative sign is just showing that it is a loss. Okay. So ST minus X is the total loss made by the call writer if stock price is higher than the contract price. 0 if contract price is equal or greater than the strike price. Sorry, the spot price. That means essentially that the agreement is selling you the gold at the price which is higher than the market. So why somebody will buy at the higher price? Then we'll go and buy in the market. So in that case, the option, the call option is not exercised and it is worthless or it is unexercised. Hence, the payoff to call writer is 0, which is good news for call writer because call writer cannot make profit from the call here. What can be the profit maximum? The premium. So in that case, profit to call writer is calculated using payoff plus premium. Here, whatever the premium, $1, $2, $3 they would have received, that will be the premium, the total profit to call writer. Just a pictorial way to represent what we discussed. We have always heard, we always quote, a picture is worth 1,000 words. So I'm using 1,000 words here. So 1,000 words saying that for any call owner, somebody who has bought the call options, will generally start from a loss. Why? So this line is showing no profit, no loss. Okay, here 0. This is a payoff. Okay, this y-axis is reflecting a payoff, whereas this x-axis is reflecting the stock price. So as you can see here, the call owner is starting with a loss because the premium that has been paid, say $10 or $14 of the premium that call owner has paid to the call writer is outrightly a loss here. Let me show. So this is basically, let me take a black ink. Yeah. This is essentially showing the outright loss of the call owner because he paid or she paid $10 to $14 at the start. The price was such that if if the stock exceeds $100, then the call owner will start to make money. Okay, in that case, the call owner has to wait all the way through this 100 before this much of loss can be recovered. Okay, so the loss is flat until this point 100. It's not moving, it's just flat, simple loss. When it reached 100, see, the profit started to be reflected here. Why? Like it is still below zero, but I'm saying profit because this journey from here to here is still positive, right? Because it is recovering some of the loss. That's why I'm reflecting this as a profit. So from this point to this point up to 100, there was a straight loss, a constant loss. But after it exceeded 100, then we are on the path of a profit and it is coming towards zero loss. From $14 loss, we are coming to zero loss. And the reason is that once the stock price started to move up. See, this is showing a movement of the stock price. So it is starting from say 70, 80, and then 90, and going to 100, then it went to 110. But as it reaches 114, right, then what happens? Something very, very amazing. At 114, what will you do? You will exercise, right? At 114, you will exercise the call option. It becomes profitable by $14. Now, at the same time, this $14 will be negated by the commission of $14 as well. So you are making zero profit, but at least you are making zero profit here, not a loss. So long as it was say 110, right? So you're making only $10 profit on the option, but $14 of commission. So you had made a loss of $4. So that's why you see here you are still in loss. And at this point, when you had only $100 of the stock price, you are making a complete $14 loss. So basically, up to $100, you are making $14 of loss, the loss on the commission. But as the price starts to go up, your profit starts to go, sorry, the loss started to get better and you become at zero loss here. And once the price further goes towards 120, see, you have started to make a profit here at 120. Imagine this is 130, right? Now you will be somewhere here and making some profit of say $10 or something like this. Then you will see a profit shooting up when you make an imaginary line going there and stock price is going to 140 or so, you are going to make a profit, right? But this is a critical area, this triangle. You are moving from the total loss of premium to zero loss between 100 to 114. And once you have covered your premium, then you start to make a profit. And to cover your premium, you need to wait until the stocks goes higher than the strike price, sorry, um, strike price and the premium paid, right? So this is how the graphically we can represent the call option. The opposite to call option is the opposite payoff to the call owner is call seller. Call seller here is talking about the gain And it is kind of very intuitive that whatever the gain the call seller has made is only going to be there up to the point when the stock is trading at $100. As soon as the stock stops to trade at $100 basically, and it exceeds 100, there's a chance that the call buyer will come back and will say, hey, I want to buy the stock at $105. That means the call writer or the call seller is going to make a loss of $5. So if it makes a loss of $5, what will happen? The premium paid $14 will start to be netted by a loss. So this reflects again, this reflects a loss, and there will be only $9 of profit. So see, the profit is started to go down. Imagine this stock is becoming now 110. Then what will be the loss? The loss will be $10. So that will be further reducing my overall profit. So 14 minus 10 is 4. So the tendency is that as the stock price goes up, the profit on the for the call writer will start to go down. And that's what we are seeing here. The straight line, which represents the commission at the start, which was paid to the call writer, is only going to be beneficial until the price is 100. As the price goes this way, means the price is going up, this $14 is going to get towards zero. This profit will disappear. This is going to disappear. It is going to be zero as the price goes towards 114, because once it reaches 114, the $14 will be netted off by the buyer will come back and will ask for the share at the rate of 100. That will cause a loss of $14 to the writer. And writer will say, okay, then I'm going to lose my premium as well. So 14 loss is netted by the 14 of the premium, and then there is zero profit. So see, this profit line is passing from this point 114, which means at this point there is no gain, no loss to the call writer. The call writer is making no profit, no loss when the stock price is 114. Okay. So we'll talk and we'll continue this session until we go through the put options, buyer and seller. And in the subsequent sessions, we'll also discuss about some more exotic options, their valuations, the Black-Scholes valuation models of options, plus various other interesting stuff. But today we'll try to finish off with the call and put, payoff and the profit. So moving on to the next one. So in a way, by way of formula, we can see payoff to put holder is 0 when the stock price in the market is higher than the exercise price. So payoff and profit at expiration is, for the profit, is just 0, because the holder is not going to exercise the put option, because the holder can just sell something expensive in the market, because market price is higher, contract price is lower, so it will expire worthless. But if the stock price in the market is lower but the agreement price is higher, then what will I use? I will go for the agreement price, which is exercise price. Oops. Which is exercise price. So who is going to lose or who is going to gain? I'm going to gain because I have the I have the put options. I'm going to sell something expensive at a higher price to the person who gave me that option. So I'm going to sell gold at 45K even though the market is at 40K. Because I have the rights, I have the put option to sell at 45K. I'm going to sell at this rate and I'll make extra money. So this is my profit. 45K is what? This is extra exercise price. So this denotes 45, ST denotes 40. So I'm making 5K profit per contract. That's my payoff. Of course, this is a payoff to put holder, but I would have paid a premium as well. So reduce 5K times the number of contracts, maybe number of contracts minus premium I paid, and that will be my net profit, final profit. Okay. We should check this as well, how it looks in a graph and a formula. So first, we just reverse the side. What will be the loss or gain to the guy who wrote that put option to me? Somebody who sold me that put option, we need to consider their gain or loss as well. So what is their position? So in case the exercise price is lower than the stock price in the market, I'm not going to exercise, means the put owner or the put holder is not going to exercise. So no loss, no gain, no impact to put writer. However, if, as I said earlier, the market is crashing, the market is in red. So I was thinking that I'm buying a gold and will sell at 50K while I bought the gold at 45K. I also bought a put option to sell my gold at 45K even though the market is at 40. So what happens is, if market is at 40, my agreement with the put holder is at 45K, I will sell at 45K. Now the put provider or the put writer is in red. He or she will make a loss of minus 45 minus 40, a net loss of 5K. So here X is representing exercise price, ST representing the stock price. So I'm making a loss of 5K per contract. Now profit to put writer is basically the net of how much loss is made from the contract or the market price plus the premium. Often it happens, it ends with 0. So all the premium is accrued or all the premium is pocketed by the put writer. But if market has made a massive loss to put writer, then entire profit will be in red, because the premium will be written completely netted off, because the loss was bigger on the contract. So generally, when we calculate the total profit to put writer, we need to calculate the payoff plus the premium and then see whether it is a minus number or plus number, whether it is a negative or positive, or whether it is a loss or gain. We need to check premium. We need to add premium to the total payoff to the put writers. How we show this graphically? So basically, whenever there is a put options written, it starts with a gain here, and the gain is such that put buyer, this is reflecting the buyer side, the holder. So the put holder is actually looking at the total profit to start with, and as it makes the progress, the loss is going to reverse for the payoff as well. So price of put is going to be the difference between the $100, which is at 0. So starting with this line, which is reflecting the stock price of in the market, this is reflecting the overall gain or loss of the put. So basically, as the stock prices is going to go up gradually and exceeding 100, the holder is going to make the profit. So it is similar to what we have seen for call options, but it's just the opposite side. Okay. So as the next exercise, I have just kept this blank, and we will draw it manually so we can make a more intuitive analysis. So what will happen to the writer of the put option? The writer of the put option start with a net profit of say $10. And why it is so? The question is that why the writer of the put option start with a profit? That is because the premium that is received, this is giving starting or initial leverage or profitable situation to the writer, because without doing anything, without any market movement, the person has pocketed say $10. Now that will start to go to 0, right? As the market situation will change. When the profit of the writer of the put option will go to 0. That happens when somebody who has the right to sell a stock comes back and say that, okay, I want to sell something at a higher price, because generally everyone wants to sell the stock or the commodity at a higher price. Okay, so when the price is crashing at that point of time, the person would like to sell something at a higher price. So let's try to, let me make an edit. Okay. So this is the situation when we have $100 worth of stock, or this is the exercise price. There was a commission of $10. So $10 of commission was so the price is starting from 0, reaching 100 here, and then it is also reflecting a $150 price. So if we are moving into this direction, so the person, the the writer of put option is not making any loss up to point of 100, because the stock was at 150 when the contract was written. Then $10 was paid, so $10 is reflected here, as you can see, as a gain. Now, so long as the stock price is not below, so this scale is reflecting the stock price, okay, and there's a chance that it can move from 150 to 125 to 100 to 75, 25 and 0. Okay, so as it is making the progress and not going below 100 threshold, there is no impact to the call writer. Call writer is still enjoying that $10 that it had. Sorry, the put writer is still enjoying the $10 that it had. Now, the challenge is once the stock price is below 100, see, it is going to us 0 on this line. So if the stock is going down below 100, it is quite likely the person, the holder of put option will come back at this point. And we'll say, okay, so we had the agreement for 100 and now the price is at this point 99, 98, 97, 95, etc. So I want to sell it at 100, even though basically we need to sell it to you at 98. That means the profit of $10 is going to be gradually eroded. It will gradually start to disappear in slices, because the stock is going below 100 and the holder of the put option do not like this. So the holder of put option will come back and will try to sell the stock at $100 only. That will mean that basically the loss of $2, $3, etc. will start to accrue. It will start to get bigger and bigger as the price of stock goes to 0. And in that case, the $10 of profit that the writer of the put option had will start to get to 0. And then once the stock price become 90, the put holder will start to face loss. This is a red zone. Let me strike this in red. Okay, so this is a red zone here. So far, it was here, kind of a silver zone, because it was because it was in the profit up to dollar here, $100, but now it is starting to go into red zone, and as it crosses 90, it is into red zone. It has made a loss, which is a problem for put holder. Sorry, the put writer. The writer, which was enjoying the premium here of $10, is starting to lose the benefit from that premium, because it has to comply with the terms of the options. So that is the graph. That is the pictorial representation of how the payoff of the call and put option works, plus the total, all the risk and reward of the call option, the put options, how one trader or the investor should be careful about the different features of options. The call option and the put options both are opposite in sense of the transactions, but their risk and reward profiles are still different. While the call holder has unlimited benefits, especially in case of the call, the owner has unlimited upside potential. The loss or the risk potential of the call owners or the option owners are very limited, and that is limited only to the premium paid. As the option owner, I do not have any massive risk except for the premium that I have paid. Worst case scenario, what can happen? My premium that I have paid can be lost, can remain unexercised. But if the market is going against me, the same option will protect me. In that case, I will make massive gain because of that options. If I'm using that option for speculation, then I can also make massive profit. So basically, as the option owner, I have massive upside potential, especially if I say as a call owner, I have unlimited gain potential. As a put option owner, I have a limited upside potential. Okay. Now, as the owner of options, I have a limited downside risk, means limited risk to lose money, because only maximum I can lose the premium. But if I take the other side of the table, if somebody is the writer of the options, in that case, writer of call option has unlimited risk, unlimited downside potential. As a writer of call option, a company can wipe out the entire profit, because as we discussed, the price of a stock can go infinitely up. And if I promise somebody to sell a stock at say $10 and the stock goes to say $5,000, it is massive loss. Or it can go $10,000, or it can go to infinite amount, and I can make infinite loss. Hence, a writer of the call option can have unlimited loss potential, but writer of the put option has a limited downside risk, limited hazard. Okay, so we need to be cautious and aware of what are the different risk and reward profile of the option writers, option owners, how options are used, call and put options are there, and we have discussed how we can calculate the value, gain and losses of options. There are various pictorial way also to represent this. So after this session, we'll have a sequence of videos and sessions on options, and subsequently we'll also have sessions on other derivatives. So keep watching and send your questions and queries. Subscribe to the channel. You'll continuously get more and more updates on derivative, capital market, and varieties of business topics, even emerging technology, etc. So we'll look forward to see you again in the next session. So in the next session for option, we will talk about some more varieties of option as the financial derivative, and some of the features, valuation models, including Black-Scholes and Merton valuation models, how it works. There are put call parity and straddle, various butterfly kind of various different option strategies which are used in the trading, in valuation. We'll be talking about that in the next few sessions for options, and we'll have videos and sessions on derivatives as well. Thank you so much for watching.